Hi guys, let's discuss about IAS 7, particularly cash and cash equivalent. According to IAS 7, cash and cash equivalent comprise of cash on hand, demand deposit, and short together with short-term, highly liquid investments that are readily convertible to a known amount of cash and that are subject to an insignificant risk of changes in value. Let's break this down. Cash on hand is your physical cash, physical money that you have, notes, coin with you. Then money in your bank account that you can use at any time without restriction. Without restriction. That is about cash on hand. Then demand deposit also. For example, a real estate storekeeper that has 100,000 in his cash register for daily transaction. It also that is cash on hand. Then if you also have like 500,000 in a current account, which you can withdraw at any time, these both are cash and cash equivalent. Now, particularly on the demand deposit, there are some money that you have in your bank account that are not uh, that cannot be classified as a demand deposit. For example, if it happens that you have a fixed deposit that is maturing as at the date of report that is maturing 6 month time, this cannot be categorized as demand deposit because it's a fixed deposit and it can only be turned to cash in 6 month time. According to the guardian's notes, uh, short-term, highly liquid investment between investment that are between 3 months or less, between 3 months, either 3 months or lesser. You understand? Then, if it happens that your bank account is frozen by court order, of course, when making a report, you should not recognize this as a demand deposit because you can't have access to this balance, right? Then, but if you have a fixed deposit that is in 2 month time on it or in 3 month time that you can withdraw without any penalty for early withdrawal, you can recognize that as your demand deposit. Also, that is to say, as your cash and cash equivalent, right? Now, when it comes to short-term investment, so if you even look at the aspect of shares, you might not recognize shares as a short-term investment, but there are instances whereby you can actually do that by recognizing your shares. Like preference shares, for instance, that is close to redemption. So a preference shares, so if they are redeemable in 3 months' time, so let's say a company buys preferred shares on May 1st and it will redeem for a fixed amount on July 15th. May, June, July. This is still within 2 to 3 months. Now, since the redemption is near and at a known price, they will be considered as cash equivalent, right? But it's not more than 3 months. But if it is more than 3 months, we wouldn't recognize that. The equity investment are usually excluded when it comes to shares. So if you are buying shares of a company, so if you look at a particular clause that says that are readily convertible to a known amount of cash and are subject to an insignificant risk of changes in value. For instance, if you buy a company stock or shares, of course, you know it is possible that within a second, within a minute, the price of that shares would have changed drastically. So we wouldn't want to recognize those as cash and cash equivalent because there is a risk, higher risk of changes in value, right? Very important aspect is bank overdraft. Now, most time we see bank overdraft as a liability, let's say a current liability, right? But if your bank lets you spend more than you have, that is the overdraft in your bank account, and you can pay it back at any time, it can be included as part of cash. That's if you use it regularly to manage your daily finances, right? At demand, you can easily pay. So you are using it maybe to just settle some. Let's say, for instance, a company has a bank overdraft of 200,000 that is used regularly to cover short-term cash needs, since it's always part of how they manage cash flow. It counts as cash equivalent.